This is a download from BFM 89.9, the business station.
Good morning, Dodge. Let's take a quick look at the data that was released last week. Strong retail sales numbers. Has that assured you of the health of the U.S. economy?
Well, good morning, Melissa. Not exactly. I think we are okay, but I'm a little concerned about the longer term. Yes, overall, retail sales did grow by 1.3, and even last month was improved from 0.4, which was previously reported, to 0.3 decline. That is really good, and we're seeing car sales climb 3.2% compared to the loss that they had the prior month. But what I'm really seeing is the retail growth is slowing amidst, from an economic point of view, a darkening outlook. Not that we aren't growing, it's just that we're not growing as fast as we were hoping to at this part of the economic cycle. And the growth that we have had so far has been really supported more by lower interest rates than pure economic growth. Yes, we are still spending, but while we're spending, we're doing so much more selectively. We're choosing which products to buy, which retailers to visit. We're paying more attention to price and value for the money. Also, there is much more growth in non-store retailers, including online shopping. And so that really does mark a vast change in the shopping habits, and it will definitely affect our retail sector quite a bit. We're seeing a lot of negative reports coming out in terms of stores, et cetera. So you have to be much more selective in the investments you make in the retail area.
Yeah, I found that particularly interesting, Dodge. Simply looking at the breakdown of the data, the numbers seem to show a widening divide between online shopping and in-store retailers. So what was once considered bellwethers of consumer behavior, large departmental stores and the stocks that reflect them, do you no longer see them as bellwether stocks for the consumer side?
Yes, you are correct. I agree with you totally. And in fact, I'm seeing two other things. First of all, human behavior is definitely changing. And that is a much longer term and much more important than just talking about a sector. Human behavior we see as a theme across different investment vehicles, investment varieties, investment categories, and we're seeing it now in retail. Also, there is a transition in what is being viewed, what is being defined as sound management. Management has to be able to adapt to the changes, and we're not seeing that in some of the prior bellwether companies, as you were saying. And so you're going to have to be much more selective in where you go. Retail overall is quite negative now, and in fact it is affecting one other area. We're watching retail REITs, Masaryk as an example, but REITs overall have been quite positive because of their high yield, and they're getting a lot of positive investment themes now in our market, but retail REITs are not. Also, the type of retail that you're looking at, even the online companies are now suffering from a little short-term pullback, Amazon. But Amazon is really where it's growing. They're talking about hiring 5,000 people in India. They're rolling out private label brands within a couple of weeks, it's been reported. So that's really where the action is, and we suspect that they will be the first to exhibit an online performance and in growth performance. And that's what we're looking for in terms of investment opportunities. It's going to take much more for Macy's, Kohl's, to show this. And in fact, we're seeing where we thought human behavior and excellent management was going to hold up with Nike and with Starbucks. Those are also undergoing some pressure now. So it's going to be a much more careful selection process.
Well, Dodge, going back to your view of the health of the U.S. economy, now the FOMC will release minutes from its April meeting later this week. What are you expecting in terms of fresh insight into the thinking of the Fed?
Well, it's kind of interesting, Melissa, because really the Fed has temporarily disappeared from the center of our focus because the probability of a June rate hike has been receding. Even earlier hawks that we were watching among the analyst community, they have sharply reduced the number of rate hikes that they're expecting this year. And so we're not expecting as much in the June area. It's still back-ended into the end of the year, particularly December. The most recent evidence we've seen was from the Bill Dudley, who's the head of the New York Fed, he had an interview, and it became clear, although it's not been really followed because right now there's not as much concern for an interest rate hike, but the Fed has finally become fully data dependent, and so there's really no longer any attempt to give calendar guidance to the markets on when to expect rate hikes. Also, gross domestic product growth at 2%, that appears to be the new benchmark. Mr. Dudley thought that this is now above the trend, the rate of growth of the economy, and so it's really consistent with a much gradual further tightening of the labor market. So we're really not expecting or seeing as much pressure to have an earlier interest rate hike. Also, he made a case for running our economy a little hot in order to get long-term unemployment down, and all of this shows that right now there is not much of an expectation for an early interest rate hike.
Okay, well, China made headlines again this weekend, Dodge. The central bank came out to reassure investors that monetary policy would continue to be geared towards supporting the economy there. But, if you look at the data for the month of April, it really showed that China's economy seems to be on this yo-yo trajectory. What do you make of the comments of the PBOC? What can we expect in terms of action from Beijing?
What I'm looking at is the amount of support that the government has to give towards their policy. And despite the disappointing release of April data showing the banks had cut back sharply on their new loans, that's a fact. And the excuses or the reasoning behind it, there's more reasoning that has to be given now, and so that's really what we're watching. Banks made 556 billion yuan in net new loans. That's much lower than the 1.37 trillion yuan that was expected and made in March. The slide was attributed to seasonal and technical factors. Okay, that's fine. They did exclude new local government bond issuance to refinance debt previously issued. Yes, I agree. But the fact that the government has to give excuses for supporting its policy, that's really much more of a concern for me right now. And that's really, yes, I'm watching what they have to say, but what I'm really watching is their emphasis on making excuses.
Thanks so much for your time. Have a great week ahead. That was Dodge Dorland, Chief Investment Officer of Landor and Fuest Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.